We need to talk about silver, not because it's trending on social media, not because some guru promised you overnight riches, but because something fundamental is shifting in a market most investors completely ignore. 1.5 billion ounces. That's the projected annual demand figure that's quietly rewriting the rules of the silver market. To put that in perspective, that's nearly 47,000 metric tons of physical metal that the world needs every single year. And here's what should concern you. We're not mining enough to keep up. I'm not here to sell you silver. I'm here to make sure you understand what's happening in this market, whether you own it, you're considering it, or you've dismissed it entirely. Because the dynamics unfolding right now represent one of those rare moments when supply, demand, and macroeconomic forces align in ways that create genuine structural change. This isn't speculation. This isn't hope. This is mathematics meeting reality. For the next 25 minutes, we're going to examine this market the way serious investors should, with clear eyes, rational thinking, and an understanding of both opportunity and risk. We'll look at why demand has exploded. We'll examine what history tells us about supply deficits. And most importantly, we'll discuss what this means for your portfolio and your financial future. Whether you hold silver or not, the shifts happening in this market offer lessons about resource scarcity, industrial transformation, and how to position yourself when fundamental economics override short-term price action. Let's get to work. The silver market isn't behaving the way it used to, and before you can make any informed decision about this metal, you need to understand why. Traditional silver demand came from three main sources: jewelry, silverware, and photography. That world is gone. The silver market of today is driven by forces our grandparents would barely recognize. Industrial applications now consume approximately 50% of annual silver supply. Solar panels alone account for over 140 million ounces per year, and that number is accelerating as countries push toward renewable energy targets. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. Medical devices, water purification, and electronics manufacturing all depend on silver's unique properties. Why silver specifically? Because no other element combines electrical conductivity, thermal conductivity, and reflectivity the way silver does. Engineers don't use silver because they want to. They use it because they have to. This creates an entirely different demand profile than precious metals held purely for investment. When silver goes into a solar panel, it doesn't come back. When it's bonded into an electronic circuit board, it's essentially removed from the supply chain. Industrial demand is consumption, not accumulation. Now layer on investment demand. Exchange-traded funds, institutional buyers, and individual investors collectively represent another significant portion of annual demand. During periods of monetary uncertainty or inflation concerns, this segment can surge dramatically. We saw this in 2020 and 2021. We're seeing renewed interest now. Then there's the sovereign question. Central banks have been accumulating gold for years. They don't report silver holdings the same way, but several governments have strategic stockpiles for industrial and defense purposes. This demand is quiet, consistent, and non-negotiable. Add it all together, and you're looking at approximately 1.5 billion ounces of annual demand across all categories. Some years it's higher, some lower, but the trend line points in one direction, up. Here's where the mathematics become uncomfortable for the supply side. Annual mine production sits around 830 million ounces. That's it. The world pulls roughly 830 million ounces of silver out of the ground each year, and that number hasn't grown meaningfully in over a decade. The gap gets filled by recycling, which contributes another 170 to 180 million ounces annually. But recycled supply has limitations. You can only recycle what was used in recoverable applications, and as I mentioned, much of today's industrial usage is effectively permanent. So you have demand around 1.5 billion ounces and supply for mining and recycling around 1 billion ounces. The deficit gets filled by above-ground stocks, existing inventories held by dealers, ETFs, and private holders. Those inventories aren't infinite. Every ounce pulled from inventory is one less ounce available for the next buyer. This isn't theory. The London Bullion Market Association reported declining silver inventories over the past several years. Exchange warehouses have seen drawdowns. The physical market has experienced periods of premium expansion and delivery delays. When you understand these numbers, you understand why serious analysts are paying attention. This isn't about price predictions. It's about recognizing that markets operating in structural deficit don't behave the way balanced markets do. Markets have seen supply-demand imbalances before. The lessons from those episodes should inform how you think about what's happening now. Let's start with copper in the mid-2000s. Rapid industrialization in China created demand that outpaced mine supply. Prices rose from around $0.70 per pound in 2003 to over 4 PLN per pound by 2006. But here's the important part. The price increase alone didn't immediately solve the deficit. It took years for new mining projects to come online, and by the time they did, demand had continued growing. The lag time between price signals and supply response is crucial in commodity markets. You can't just turn on a mine. Exploration takes years. Permitting takes years. Construction takes years. By the time new supply arrives, the market conditions that triggered the investment may have evolved considerably. Silver faces additional constraints. Roughly 70% of silver comes as a byproduct of mining other metals, particularly zinc, lead, copper, and gold. This means silver production is tied to the economics of those primary metals. If zinc prices fall and mines close, silver supply drops regardless of silver's price. Primary silver mines exist, but they're not the majority. This byproduct nature makes silver supply relatively inelastic. Prices can rise significantly without triggering a proportional supply response. History also teaches us about the role of inventories. Above-ground stocks act as buffers, absorbing temporary imbalances, but when deficits persist year after year, those buffers deplete. Once inventories reach critically low levels, price volatility tends to increase dramatically. We saw this in palladium. Years of deficit drew down inventories until the market became hypersensitive to any supply disruption or demand spike. Prices moved from around $500 per ounce in 2016 to over $2,800 in 2019. The fundamental deficit created conditions where relatively small changes in supply or demand generated outsized price movements. Silver experienced its own dramatic moves in the past. In 1980, prices spiked to $50 per ounce amid a combination of inflation fears, geopolitical tension, and attempted market manipulation. That wasn't sustainable, and prices eventually collapsed. The 2011 spike to $49 per ounce came during a different context: quantitative easing, sovereign debt concerns, and surging investment demand. Again, the move proved unsustainable because it was driven primarily by speculation rather than underlying supply-demand fundamentals. What we're looking at now is different in character. This isn't primarily about speculation or manipulation. It's about structural demand from industries that aren't going away and supply that isn't keeping pace. Does that guarantee specific price outcomes? No. Markets are complex systems influenced by countless variables. But it does create conditions where the probability of higher prices over time increases. The key word there is time. Supply deficits don't resolve themselves overnight, and neither do the price adjustments that accompany them. No commodity exists in isolation. Silver's dynamics are playing out against a macroeconomic environment that adds additional complexity and potential catalysts. Let's address monetary policy first. For over a decade, central banks suppressed interest rates and expanded their balance sheets on an unprecedented scale. That era appears to be ending, or at least transitioning. We've seen rate hikes, quantitative tightening, and renewed focus on inflation control. What does this mean for silver? The relationship isn't linear, but historically, precious metals perform well during periods of real negative interest rates. When inflation runs higher than the interest you can earn on safe bonds, hard assets become more attractive on a relative basis. We're also watching the debasement question. Governments worldwide carry debt levels that would have been considered unimaginable a generation ago. The temptation to inflate away debt through monetary expansion remains a persistent risk. Silver, like gold, carries no counterparty risk. It's not someone else's liability. In an era where trust in institutions and currencies fluctuates, that characteristic matters to a segment of investors. The geopolitical dimension adds another layer. Supply chains for critical materials have become national security concerns. Countries are recognizing that dependence on foreign sources for strategic minerals creates vulnerabilities. Silver falls into this category. It's essential for defense systems, communications technology, and energy infrastructure. Nations pursuing industrial independence will need to secure silver supplies, adding a geopolitical dimension to what was traditionally a purely commercial market. Then there's the energy transition. Governments worldwide have committed to aggressive carbon reduction targets. Solar installation projections extend into the hundreds of gigawatts annually by the end of this decade. Each gigawatt of solar capacity requires roughly 1 million ounces of silver. The math becomes significant quickly. If solar deployment matches current projections, silver demand from this sector alone could double from current levels. Electric vehicles add to the equation. The average EV uses approximately twice as much silver as a conventional vehicle. As EV adoption accelerates, so does silver consumption. Major automakers have announced plans to electrify their fleets over the next 10 to 15 years. These aren't speculative trends. These are capital allocation decisions made by trillion-dollar industries based on regulatory requirements and consumer demand. The monetary backdrop, geopolitical considerations, and industrial transformation create a confluence of factors that all point towards sustained or increasing silver demand while supply remains constrained. Does this eliminate risk? Absolutely not. Recession could slow industrial demand. Technological breakthroughs could reduce silver requirements in certain applications. Policy changes could alter the trajectory of energy transition. But when you're evaluating probability-weighted outcomes, the current setup favors structural tightness over abundance. Understanding the fundamentals is essential. Understanding how markets actually behave is equally important. Silver has a reputation for volatility, and that reputation is earned. This metal can deliver gut-wrenching drawdowns and euphoric rallies, sometimes in very short time frames. Why? Partly because it's a smaller market than gold. The entire above-ground silver inventory is worth a fraction of the gold market. This smaller size means that relatively modest capital flows can move prices significantly. Silver also sits at an awkward intersection. It's both an industrial metal and a monetary metal. This dual nature means it responds to different variables than pure precious metals or pure industrial commodities. During economic expansions, industrial demand supports prices. During economic uncertainty, investment demand takes over. Sometimes these forces align, sometimes they conflict. This creates price action that can confuse investors who expect consistent behavior. Let's talk about sentiment cycles. Markets move through predictable psychological phases. In silver, these phases tend to be particularly pronounced. The accumulation phase occurs when prices are depressed, sentiment is negative, and most investors want nothing to do with the metal. This is when fundamentals often look most attractive. But human psychology makes it hardest to buy. It feels like catching a falling knife. The markup phase begins when prices start rising, but skepticism remains high. Early gains get dismissed as temporary bounces. Mainstream attention is minimal. This is typically where the best risk-reward exists for informed investors. The distribution phase arrives when prices have risen substantially, media coverage intensifies, and late-stage buyers rush in. Everyone suddenly has an opinion about silver. Your neighbor mentions it at dinner parties. This is when discipline becomes critical. The markdown phase is the painful unwinding. Prices fall, often sharply. The late buyers panic and sell at losses. Sentiment turns violently negative. The cycle prepares to repeat. Where are we now? That's the question every investor must evaluate for themselves. Silver spent years in quiet accumulation after the 2011 peak. Prices consolidated between $14 and $20 for extended periods. Sentiment was poor. Retail interest was minimal. We've seen breakouts above those ranges, pullbacks, and renewed strength. Institutional interest has returned. Retail interest is growing but hasn't reached fever pitch. Reading sentiment requires honest assessment. Are you hearing about silver constantly from non-investors? Are price predictions becoming absurdly optimistic? Are people using leverage without understanding risk? These are warning signs. Conversely, are fundamentals improving while most people remain dismissive? Are you facing skepticism when you mention the asset? These can indicate earlier cycle conditions. The key is separating your emotions from your analysis. Fear of missing out drives terrible decisions. So does stubborn attachment to losing positions. If you already own silver, you're facing different questions than someone considering an initial position. First, know why you own it. If you bought silver as insurance against currency debasement or systemic risk, then short-term price movements shouldn't change your thesis. Insurance doesn't perform every year, but it serves a purpose in your overall risk management. If you bought for capital appreciation based on supply-demand fundamentals, then you need to monitor whether those fundamentals are playing out as expected. Are deficits continuing? Are inventories declining? Is industrial demand growing? If you bought because someone told you it would triple in 6 months, you need to reassess immediately. That's not a strategy. That's gambling. Position sizing matters enormously. If your silver holdings represent 25% of your portfolio, price volatility is manageable. If they represent 50% or more, you've created a risk concentration that could devastate your financial position during a downturn. Precious metals should serve as portfolio diversifiers and inflation hedges, not as core holdings for most investors. The appropriate allocation depends on your risk tolerance, time horizon, and overall financial situation. Consider your time frame. Are you holding for 3 months or 3 years? Silver is not a trading vehicle for most people. The volatility will shake you out if you're operating on short time frames without professional risk management skills. Multi-year perspectives allow fundamentals to work. They allow supply deficits to compound. They allow industrial demand trends to mature. They also allow you to weather the inevitable drawdowns without emotional decision-making. Rebalancing discipline is critical. If silver appreciates significantly and grows from 5% to 15% of your portfolio, trimming back to your target allocation locks in gains and maintains your intended risk profile. This isn't market timing. It's systematic risk management. You're not predicting what silver will do next. You're maintaining a consistent approach regardless of price action. Storage and form matter. If you own physical silver, ensure it's properly stored and insured. If you own ETFs, understand the structure and any associated fees. If you own mining stocks, recognize that you're adding operational and management risk on top of metal price exposure. Each form of exposure carries different characteristics. Physical metal provides direct ownership but lacks liquidity and carries storage costs. ETFs provide liquidity but add counterparty layers. Mining stocks provide leverage to metal prices but can underperform or even decline if companies execute poorly. Tax implications deserve attention as well. In many jurisdictions, physical precious metals face different tax treatment than securities. Long-term versus short-term holding periods affect your tax liability. Consult with qualified tax professionals about your specific situation. For existing holders, the current environment suggests patience and discipline. The fundamental case appears to be strengthening, but that doesn't eliminate the possibility of sharp corrections or extended consolidations. Avoid the temptation to overtrade. Every transaction creates costs, tax implications, and emotional stress. If your thesis remains intact and your allocation is appropriate, sitting tight is often the hardest but most profitable strategy. If you don't currently own silver but find the fundamental case compelling, how should you approach the decision? Start with education. Don't invest in what you don't understand. Read about supply chains, industrial uses, monetary history, and market structure. You need to build genuine conviction, not just chase performance. Define your objective clearly. Are you seeking portfolio diversification, inflation protection, exposure to industrial demand trends? Your objective determines appropriate allocation and vehicle selection. For most investors, silver should represent a small portion of overall holdings. Starting with 2-3% allows meaningful exposure without creating inappropriate risk concentration. Consider a dollar cost averaging for entry. Rather than committing your entire intended allocation at once, spread purchases over several months. This averages your entry price and reduces the risk of buying at a temporary peak. Yes, you might miss some upside if prices run higher immediately, but you also protect yourself against buying right before a correction. For non-professional investors, risk management trumps optimization. Vehicle selection requires thought. Physical silver provides direct ownership and no counterparty risk, but it carries premiums, storage costs, and liquidity challenges. Selling physical metal in a hurry typically means accepting dealer spreads that can eat into returns. Silver ETFs offer liquidity and ease of trading within investment accounts. Major funds like SLV or PSLV provide different structural features. SLV holds physical silver backing shares. PSLV allows physical redemption in certain quantities. Understand these differences before investing. Mining stocks offer leverage to silver prices. When silver rises, well-managed mining companies can see earnings multiply. But they also carry operational risks, management risk, geopolitical risk, and can underperform metal during certain periods. If you choose mining stocks, diversification within the sector becomes important. Don't bet everything on a single company. Consider ETFs that hold baskets of silver miners if you want broad exposure without individual company risk. Avoid leverage unless you're a professional trader. Leveraged ETFs, futures contracts, and options create risks that can wipe out accounts during adverse moves. The silver market's volatility makes leverage particularly dangerous. Many retail investors have been destroyed by leverage in silver. The market moves against them by 15-20%. Margin calls force liquidation at the worst time, and they lock in catastrophic losses. Don't let this be you. Set realistic expectations. Silver isn't going to fund your retirement in 6 months. It might provide attractive returns over several years if fundamentals play out, but those returns will come with significant volatility along the way. Prepare yourself emotionally for drawdowns. If you invest at $25 and silver falls to $20, will you panic and sell? Or will you review your thesis and possibly add to positions if fundamentals remain intact? Your answer to that question determines whether you should invest at all. Precious metals test emotional discipline in ways that conventional investments don't. Let's be direct about behavioral errors that destroy wealth in commodity markets. Mistake 1, emotional trading. Buying because prices are surging and selling because prices are falling is the fastest way to guarantee losses. You're literally buying high and selling low based on fear and greed. If you find yourself constantly checking prices and feeling anxious, your position is too large. Reduce it to a level where you can think clearly. Mistake 2, over-leveraging. I've mentioned this already, but it bears repeating. Leverage in volatile markets creates binary outcomes. You either get spectacularly rich or completely wiped out. Most retail traders experience the second outcome. Brokers and platform providers make money from transactions and margin interest. They have no incentive to protect you from yourself. The responsibility for risk management is entirely yours. Mistake 3, following gurus and price targets. Social media and YouTube are filled with people making absurd predictions about silver going to $100, $500, or even more. These predictions generate views and followers. They're not investment analysis. No one knows where prices are going in the short term. Anyone claiming certainty is either deluded or dishonest. Build your own understanding and make your own decisions based on your situation. Mistake 4, neglecting portfolio context. Silver shouldn't exist in isolation. It's part of a broader investment strategy that includes stocks, bonds, real estate, cash, and other assets based on your goals and timeline. Don't let one position dominate your thinking or your allocation. Maintain perspective. Mistake 5, ignoring tax and cost implications. Every trade triggers tax events. Premiums on physical metal, ETF expense ratios, and trading commissions all erode returns. Factor these into your decisions. Mistake 6, treating investment as gambling. If you're investing money you need for rent next month, you're not investing, you're gambling. Only allocate capital you can afford to lose without affecting your quality of life. Mistake 7, paralysis through overanalysis. Some people study forever and never act. They want perfect information, perfect timing, and perfect certainty. None of those exist. At some point, if you believe the thesis is sound and you've done your homework, you need to make a decision. Start small if necessary, but don't let analysis become procrastination. Mistake 8, abandoning discipline during extremes. When silver is crashing, every instinct screams to sell. When it's soaring, every instinct screams to buy more. Both instincts are usually wrong. Stick to your strategy, rebalance methodically, tune out the noise. Mistake 9, failing to secure profits. If you're fortunate enough to experience significant gains, consider taking some profits. You don't have to sell everything, but locking in some gains reduces your risk and validates your thesis. Investors who ride positions from small gains to large gains back to small gains or losses are making an emotional mistake. Greed prevents them from recognizing success. Mistake 10, ignoring broader financial priorities. Before investing in silver or any other asset, ensure you have emergency savings, manageable debt, and appropriate insurance. Speculative investments come after financial foundations are solid. Step back from silver specifically and consider what this market teaches about investing in general. Supply-demand fundamentals ultimately determine value in commodity markets. Prices can deviate from fundamentals for extended periods due to sentiment, positioning, or macroeconomic factors, but eventually reality reasserts itself. Physical constraints matter. Unlike fiat currency that central banks can create at will, physical commodities have production limits. When demand persistently exceeds supply, prices must adjust to ration available inventory. This principle applies beyond silver. Copper, lithium, rare earth elements, and other materials essential for electrification and technology face similar dynamics. Understanding how supply deficits unfold in one market helps you recognize them in others. The energy transition represents one of the largest capital reallocation events in human history. Trillions of dollars will be spent over decades to reshape how we generate, store, and consume energy. This reallocation creates winners and losers across every sector. Silver sits at the intersection of this transition. It's required for solar, required for EVs, required for 5G and next-generation electronics. The question isn't whether demand will grow, but whether supply can keep pace. Monetary considerations overlay the commodity fundamentals. The monetary system we've operated under since 1971, with fiat currencies backed by nothing but faith in governments, is historically unusual. For most of human civilization, money was anchored to something physical. We're not necessarily returning to gold or silver standards, but the persistent expansion of money supply relative to goods and services creates inflationary pressures that manifest over time. Hard assets with supply constraints protect against this debasement. This doesn't mean you should abandon all fiat currency holdings. It means maintaining some exposure to assets that can't be printed or created from nothing serves as portfolio ballast. The silver market's dynamics also illustrate the importance of thinking independently. Mainstream financial media rarely covers commodity markets with the depth they deserve. Analysts at major banks often miss or dismiss structural changes until they're obvious. By the time something becomes consensus, much of the potential return has typically been captured. Early-stage research and independent thinking create advantages, but independent thinking doesn't mean contrarian for contrarian's sake. It means doing your own work, questioning assumptions, and forming evidence-based conclusions regardless of popularity. Whether you own silver, you're considering it, or you're simply monitoring the market, certain principles apply universally. First, maintain emotional equilibrium. Markets exist to transfer wealth from the impatient to the patient, from the emotional to the rational, from the reactive to the strategic. Your ability to remain calm during volatility determines your long-term success more than any analytical skill. Intelligence without emotional control leads to poor decisions. Second, think in probabilities, not certainties. The supply deficit in silver increases the probability of higher prices over time. It doesn't guarantee them. Unexpected events can always occur. Position sizing based on probabilities means allocating more to higher probability outcomes while maintaining exposure to alternatives. Diversification isn't just across assets, it's across scenarios. Third, respect the difference between price and value. Price is what you pay. Value is what you get. They disconnect regularly in all markets, especially in smaller sentiment-driven markets like silver. Sometimes price overshoots value on the upside. Sometimes it undershoots on the downside. Recognizing these disconnects and acting accordingly separates successful investors from the crowd. Fourth, maintain a learning mindset. Markets evolve. New information emerges. What was true yesterday might not be true tomorrow. Stay current on supply developments, industrial demand trends, monetary policy changes, and technological advances. Your thesis should be dynamic, updating as evidence accumulates. Fifth, document your decisions. Write down why you bought, what your expectations are, and under what conditions you'd sell. This creates accountability and prevents post hoc rationalization. When you review these notes later, you'll see patterns in your thinking, both successful and unsuccessful. That feedback loop improves decision-making over time. Sixth, build systems, not predictions. You don't need to predict where silver goes next week or next month. You need a systematic approach to allocating capital, managing risk, and responding to changing conditions. Systems remove emotion. They create consistency. They allow you to execute your strategy regardless of fear or greed. Seventh, stay humble. Markets humiliate the arrogant. The moment you're certain you've figured everything out is usually the moment before you learn a painful lesson. Confidence in your research is healthy. Certainty about outcomes is dangerous. Zoom out from daily price movements and quarterly performance. Think in years and decades. The global economy is transitioning toward electrification, decentralization, and technological acceleration. These transitions require massive amounts of physical materials. Silver sits at the center of multiple critical supply chains. Its unique properties make substitution difficult in most applications. Rising prices might eventually spur innovation in thrift or alternatives, but that process takes time. Meanwhile, mining supply responds slowly. New discoveries are rare. Permitting becomes more difficult. Capital intensity increases. Even with higher prices, supply growth remains constrained. These are multi-year, potentially multi-decade trends. They don't resolve in quarters or even years. Patient capital positioned appropriately benefits from these trends without requiring perfect timing. The monetary backdrop adds additional support. Government debt levels continue rising globally. Central banks face persistent pressure to maintain accommodative policies despite inflation concerns. Currency debasement remains a structural feature of the modern financial system. Precious metals have served as stores of value throughout human history, not because of tradition, but because of characteristics that fiat currency can't replicate: scarcity, durability, divisibility, and lack of counterparty risk. Will that continue? History suggests yes, but no one can know with absolute certainty. What we can say is that the case for maintaining some exposure to hard assets remains compelling. For those who understand these dynamics, the current environment presents an opportunity to position thoughtfully for the decade ahead. Not to gamble on short-term moves, but to allocate capital toward assets likely to benefit from structural forces. This requires patience. It requires discipline. It requires the ability to withstand volatility and ignore noise. Most investors lack these qualities. That's why most investors underperform over time. They react to headlines, chase performance, and panic during drawdowns. You have the opportunity to be different, to think independently, to act rationally, to position strategically. We've covered a lot of ground. Let's synthesize what matters. Silver faces a structural supply deficit driven by surging industrial demand, particularly from solar, EVs, and electronics. Annual demand approaches 1.5 billion ounces, while supply from mining and recycling totals roughly 1 billion ounces. The deficit draws down existing inventories, creating tighter physical markets and increasing price volatility. Historical precedents suggest that sustained deficits eventually force significant price adjustments. The macroeconomic environment adds support through monetary expansion, inflation concerns, and geopolitical focus on critical material supply chains. These fundamentals don't guarantee specific outcomes, but they shift probabilities meaningfully toward higher prices over multi-year timeframes. For existing holders, maintain discipline, stick to appropriate position sizes, rebalance systematically, avoid emotional trading. For potential investors, start with education, define clear objectives, begin with modest allocations, use dollar cost averaging for entry, choose appropriate vehicles. For everyone, avoid leverage, ignore price predictions, maintain portfolio context, and prioritize emotional discipline. The silver market offers lessons that extend beyond this specific commodity. Supply constraints matter. Monetary policy matters. Industrial transformation creates winners and losers. Patient, rational capital compounds over time. Whether you choose to invest in silver or not, the analytical framework we've discussed applies universally. Understand fundamentals. Respect market structure. manage risk, control emotions, think independently, the opportunity in front of you isn't about getting rich quickly. It's about positioning appropriately for structural changes that will unfold over years. It's about maintaining discipline when others panic, about staying rational when markets become emotional, about thinking clearly when noise becomes deafening. The mathematics of 1.5 billion ounces of demand against 1 billion ounces of supply creates a fundamental reality that markets will eventually have to reconcile. How that reconciliation occurs, over what time frame, and with what volatility along the way remains uncertain. But the direction of the structural forces seems clear. Your job isn't to predict the path. It's to position appropriately for the likely destination while managing the risks inherent in that journey. Do your research, make informed decisions, size positions appropriately, maintain discipline. The silver market is sending a signal. Whether you choose to listen is up to you. But don't say you weren't warned when supply deficits that have been building for years finally force the market to respond. This is your wake-up call. What you do with it determines whether you're positioned for what comes next or caught unprepared when structural reality overwhelms sentiment. The choice, as always, is yours.